Hello, everyone. Thank you, everyone, for joining us today. We are about to start. If you want to leave in the chat where are you from and from where are you watching us, we're happy to have you all here. So we have Tarek with us today. Sorry, I don't know why the presentation isn't loading. Give me 1 second. So we have Tarek talking about passive investing 101, how to analyze a real estate deal for passive investing. And we're super happy to have him with us today. So feel free to use the chat box and the Q&A box to ask him all the questions that you may have, so he's able to answer them as soon as possible. Also, if you can, answer the poll that should appear on your screen, so we get to know you better and we know if you are already a Real Estate IQ subscriber and if you would like to have a free demonstration of our tools, so someone from our sales team is able to contact you as soon as possible. So we are Real Estate IQ. Your deal is our mission, and we are deal maker and dream maker, and we provide the best real estate solutions committed to help one more person to win. So make your deals come true. So this is a streamline your deal making process. So these are the solutions that we provide. We offer off-market leads. We provide daily updated lists Monday to Friday of motivated sellers to contact. Get the freshest data mined straight from the card houses. We also offer EVA CMA, run real estate comps in seconds with our renewed CMA. You can check each property's data, select the ones to compare, and get reports instantly. We also offer you custom leads mining. Looking for specific area leads, please look no further. We now provide custom off-market data mining all over 50 states. And last but not least, we also offer you virtual assistants. So one solution for administrative tasks, customer service, and technical support to grow your business. So let's walk together toward your success. If you're looking for more, please try our exclusive membership. So these are our social media accounts where you can follow us as well. We are in Instagram, Facebook, LinkedIn, and YouTube, and you can use the QR codes that appear below of each icon so you can join us in our community. You can also use the QR code that appears on the right side of the screen so you can join us in our newsletter so you don't miss any of our weekly webinars and in-person events. You can also get a free 30-minute in-depth consultation of Real Estate IQ's services with one of our experts. Feel free to schedule it now by scanning the QR code that appears on the screen. Also by sending an email to bracenet@realestateIQ.co or by answering the poll that should appear on your screen. So this is a very short video of what we do at Real Estate IQ. Okay, so moving forward to you, Tarek. Thank you again, everyone, for joining us. Again, feel free to use the chat box and the Q&A box to let Tarek know all your concerns during the presentation.
All right. Good afternoon, everyone. Thank you, Valentina. Glad you guys could join us today. Hopefully, you're not affected by the AT&T and other cell phone carrier outages going on this morning. But glad you all could make it for our presentation today, where we're going to talk about basically passive investing 101, and more specifically, how to analyze a multifamily deal for passive investing. As Valentina mentioned, my name is Tarek Moussa, and to give you some background on me, um, my background is that I actually come from the world of investments and investment banking, finance, and I actually used to work at BlackRock in New York City, the largest investor in the world with about $10 trillion in management. So we know a thing or two about the investment world and have decided to really focus our efforts, whatnot, in the real estate and multifamily world in particular, because that's just where we found the best opportunities for long term, both from an equity growth perspective, as well as tax benefits and so on, optimization in the long run, which I'm sure, as a lot of your folks on this call must know, being in the real estate world, and really how a lot of those benefits can scale when you take it into the commercial world, like multifamily. So what we're going to cover today is a quick little intro about multifamily investing, and then why we believe in multifamily as the ideal choice of real estate, how you guys as passive investors can invest in multifamily, and then what do those kind of typical deal structures look like, as well as getting started as a passive investor in particular. What does the overall process look like for investing? And then I'm going to give you a case study of one of our deals that we did, so you can see for yourself the ins and outs and the good, the bad, the ugly that came with it. And then in the end, we'll wrap it up with some Q&A and how you can maybe get in touch with me further if you have any additional comments or questions that may come in the future. So let's go and get started. So why we believe in basically real estate, multifamily in particular. We love it because it requires very little time commitment for passive investors. I say that because once upon a time in the past life, we used to do single family properties before we eventually grew into the commercial and multifamily space. And what we realized is that it takes a lot of work to buy a property, but to buy a single family property and take that to a bigger multifamily property, it's not that much extra work. So it scales a lot better. And then also we love it because it has cash flow distributions, basically those monthly income checks. The challenge with kind of single family or smaller multifamily properties is that if you lose a tenant, well, then you're not going to make money that month, right? You might have to be losing money because of having to turn the unit for the next guy. But with multifamily, you have enough kind of diversification and risk to offset those tenants that may not be paying and keep cash flowing constantly. Of course, real estate comes with tax benefits that are very substantial, and multifamily, because of its larger scale, allows us to scale up a lot larger. We have individuals basically taking millions of dollars of tax write-offs each year, and it's been basically as powerful as the equity growth on its own, if not more, depending on your personal tax situation. And of course, multifamily is one of the most stable asset classes out there, known as the darling of real estate over the past decade or more, really. If you look back at from the global financial crisis and every really recession thereafter, and even before that, multifamily has always held a special place in the real estate world in the eyes of the lenders and Fannie Mae and Freddie Mac and the government, because, of course, it provides a necessary part of our economy, the housing and of life. But on top of that, it's just very, very stable because you are always going to need a place to live, and ideally, the government wants to see that maintained and taken care of. So it gives preferential treatment in how it's taken care of. And then, of course, one of the beauties of real estate is that as an alternative asset, you can invest through things like your self-directed IRA or your solo 401k. So it's not limited to only your individual assets. So ways that you can actually participate as an investor and basically get involved in a multifamily deal. Number one is you can invest passively in someone else's deal. This basically takes up a little time from you, but it also comes with substantial tax benefits, right, which is nice. The second way is that you can buy a deal completely on your own with your own money. Of course, in this scenario, you assume complete risk, but you also maintain full control of the deal. The third way is to partner with someone else who's already doing a deal. This is a very quick way to get your foot in the door and actually get started as a deal if you're an inexperienced investor, and you get to participate with someone who hopefully is an experienced operator. Number four, you can syndicate your own deal. Basically gives you full control of the deal, as well as let you get into bigger deals, and you get to kind of spread out the risk amongst a pool of investors who may be interested in joining you. And then lastly, you could invest in a real estate investment trust, or what's known as a REIT. And this is probably the most popular way, just because people just don't know what they don't know, and because it's just the most accessible and what's pushed by financial advisors. And it's nice because it is liquid. You get in and out pretty quickly compared to, say, a traditional syndication, but it loses all of the tax benefits and other kind of advantages that really are what real estate is known for. So when you hear the stats of real estate being the biggest driver of producer of millionaires out there, I assure you it is not through real estate investment trust investing. So interesting kind of side note. But so let's talk about the structures of what a deal could look like, right? As an investor, you can structure this really infinite ways that you can carve this cap. But some of the most common ones are either a straight split, which just means that you divide the profits evenly at all points, right? For example, a typical deal is 70% of all the profits go to investors and 30% go to the sponsors, which are also known as the operators, or basically the people who are on the ground day-to-day managing the deal itself. Another option is to include something that's called a preferred return, which is basically a requirement that investors must get at least the preferred return, and then above that is what can actually be shared as profits. And of course, that's in a preferential way. And really, however you structure the deal, the overarching name for the view of it is called a waterfall structure. People ask you, like, what is the waterfall? And a very typical deal in our world may be 8% preferred return, followed by a 70-30 split until the deal hits 18% in IRR, internal rate of return, and then thereafter 50-50 split up until basically exceeding the 18%. So let me give you a breakdown what that means. This means that investors who participate in the deal must get at least 8% return on their money, and this is annual, of course, not just overall, 8% each year on their money. And then above that amount, if the deal could produce more than that, that will be shared in a 70-30 split, 70% going to investors and 30% going to the operator. And that's up until the investors get a total of 18% IRR. If the deal can produce even higher than 18% IRR, which are probably the exception these days technically, or more likely, then the profits above that is split as a 50-50 ratio. And this kind of structure, for example, incentivizes the operator to make sure that, hey, number one, you're putting your investors first, and number two, that you're incentivized to try to optimize the deal and maximize the return, because the better the deal performs, then the more you're going to make as the operator, and of course, the more the investors are going to make along the way as well. So it aligns interests across the board to make sure everyone wins across throughout the whole deal life cycle. So when you're looking at basically investing as a passive investor, here are some key questions I think are important to ask any operators that you're considering looking at their offerings for, which is that, number one, is the sponsor themselves investing their own money in the deal? That I think is probably the ticket, the price of entry, just to even be considered. Because if you are not willing to put your own money in the deal that you believe in, then the question is, do you really believe in it that much? And as an investor, I would caution you to not participate with somebody who maybe doesn't put their own skin on the line as well. Second question is, how is the deal being structured? Like we just talked about, is there a preferred return? If so, what do those splits look like? What are the hurdles, the numbers basically when the splits may change? Number three, what is the expected length of the project? Is this a quick flip over 2 years, or is it a longer term 7 to 10 year hold project? It's not that one is better than the other. It's just that every deal has its own requirements, and you just make sure that whatever the requirements of that particular deal is will align with your investment goals and strategies. Next question that I think is appropriate is, what fee structure will the deal have? You want to make sure that the deal, for example, is not overly rich, right? And you don't make it too ridiculous, right? You don't want the sponsor to not make it worth its while to actually optimize and maximize the return for you, but you want to make sure that they're also not being too greedy and asking for too much. There are some operators out there, for example, and I won't name names, who have asked for acquisition fees of 5%, which is ludicrous because the standard out there is really 1 to 2%. In some cases, 3, depending on how much work is required. But you want to make sure that whatever the fee structure is going to be sensible, in line with the market, and something that you can tolerate and accept within your investment strategy. And of course, what is the business plan for the deal? Listen to what the sponsor has to say, because this is really going to be a make or break situation that has unfortunately burned a lot of people over the past year or two as interest rates have kind of run up on them. Because if the operator is proposing a strategy to turn around the deal and set a structure on the deal where it really just doesn't make sense or isn't very viable, or maybe just is possible but very high risk, then you got to ask yourself, does that align again with your strategy and your approach? So make sure that whatever the business plan is for the deal is going to align with what you believe is possible and what makes sense for the current market, because as the market changes, these projections and these business plans will typically evolve and have to adjust to make sure that it will work still. And then lastly, what returns are actually being projected for the property and with what assumptions being necessary. That's basically just what we talked about. As a very, very typical example I can highlight is a lot of people over the past 2 years were assuming that interest rates were always going to stay low and they can always get certain leverages and different cap rates and so on. And unfortunately, as with any market that's cyclical, the music eventually does stop. And you're finding now a lot of people in the news and elsewhere who are getting burned, and investors that are getting burned for not having done their due diligence upfront to make sure that the assumptions that were being put in place on the front end are actually sensible and are realistically possible to achieve going forward. So just make sure you take care of that. That's a very key point, probably the most important point that I would highlight. So the overall investment process, we like to divide it into 3 parts. There's the steps that happen before the closing, steps that happen after the closing, and then what happens at the end of the project life cycle when you're basically looking to do an exit. So the steps as a passive investor, what you would be doing basically before the closing is, of course, review the deal strategy, make sure that aligns with your desires and your approach, sign the offering documents, which are just the legal documents of how you're going to partner together, the terms, the risks, all the stuff that legally are required by the SEC to proceed forward. And then once you're all in agreement, everything's fine, you sign those documents, go ahead and send the funds over, which will then be used to actually close on the deal. And once you close on the deal, after that point, you are officially an investor in the deal and a partner in the property and the project. And at that point, your job is basically to receive the investor updates. Some people do it quarterly. We like to do it monthly, make sure that you have a lot more transparency and visibility on a month-by-month basis. I have basically to keep a pulse on the property and the project and how it's going. So your job is basically to receive those updates, read them, make sure you understand them, ask questions if you have any, and of course to receive your distributions when the property begins to actually pay out those cash flows. And then in the future, when you get to the point where it's time to actually exit the deal, then as an investor, you want to actually go ahead and actually begin exercising your voting rights to make sure, hey, do I like the offer that's come in? Do I think we should sell? Do I think we should hold it? Basically, add your input to make sure that your voice is heard and considered as the next steps are taken, right? And of course, once the deal does sell, you'll get the return of your capital, your initial principal that is, and on top of that, of course, the profits that come with it. And like I mentioned before, the beauty of this is that you do have the option to invest through your individual name, with your personal capital, as well as through retirement funds, like through a self-directed IRA or a solo 401k. And with that, I want to move into a case study to show you kind of example of what we've done in the past and what a typical deal kind of could look like. So this deal that we want to talk about is called Woods of Decatur. Okay, this is a deal out in Atlanta, and let's just dive right into it. So the opportunity that we liked about it and what really attracted us is a couple things. First of all, the location of it was awesome. It's in Atlanta, Georgia. It was close to a Walmart and other office buildings that were being built, and as well as one of the biggest malls in the entire area. It's revitalizing. It was really gentrifying and growing, and a lot of the redevelopment was taking place to basically add a lot more juice to the area and bring it back to life in a strong way. And the trend was already positive, and we just wanted to ride that trend. So there was a property nearby, similar property, a comp, if you will, to what we were purchasing, and it was purchased vacant at $39 a door. It was being rehabbed to be changed from what was really a C or even a D class property because it was vacant to becoming a B class property. So a lot of funds going into the area to improve it and make it much better. And the property itself, whenever we bought it, the management situation was that the owners of the property were self-managing, and these were just like a small mom and pop shop, nothing crazy, but they somehow managed to be able to buy a great property, and that has served them very well into retirement. But they obviously were not doing the ideal approach and optimizing it to the best way possible. So there's a lot of opportunity for us to come in there and actually improve and make the property better. And with that, we expect to basically come in, bring a true professional property management company and take care of the property in the way that should be done to make sure that any delinquencies are taken care of, any back paid rent actually does get resolved, any tenant requests are serviced and taken care of properly. And the other area too is that the property itself is in a very high demand area. Kind of talking about the location, right? The property itself, because of the demand all around the area, the property actually had a waiting list of tenants wanting to get in. And to give you some numbers and stats, a stabilized deal in multifamily is considered 90% occupied. When you are 100% occupied and you have a waiting list on top of that, that means that you are very underpriced compared to the market. because people are willing to pay a lot more. And if your goal is to maximize returns, then you should really bring it back to it's in line with the market to optimize the return that you're going to get for your investors. And another metric as well out here for that location was that the property that was across the street was also fully occupied, and it had a waiting list going on for 2 months in the future. So the whole area was very, very highly demanded, and not enough capacity and not enough housing there to satisfy all the need. So our business plan was basically, our strategy was to come in there, provide competent property management to operate the property in an efficient manner, improve the living conditions for tenants, basically rehab the properties, make sure that all the tenant requests take care of, improve them basically from basically rehab them from like Formica countertops to marble, from carpet to hardwood, things like that, right? Basically make it a higher quality area that people could live in. Evict tenants who are basically not paying or not basically holding up their end of the promise and maybe causing trouble for other tenants, or things like drug dealers, criminal activity, things like that. Basically folks that you don't necessarily want to have in your property, especially when you're talking about trying to build a community and not just a home. We want to make sure we get rid of those people, and also increase the rents to be in line with the market so that things do make sense. The supply demand curve does kind of intersect properly. And then our projections initially on this were that we were planning to hold the property for 5 years and produce 100% return for investors. And with a cash on cash, that was about 10%. The results of this actually, we did go in there, we were able to get a professional management company, and we did evict the non-paying tenants. And there was enough of them actually that we cut occupancy from 78% down to 55%, which at those numbers, it would seem like almost a distressed asset or distressed situation. But that was a very intentional, planned approach to cut down the occupancy, get rid of all the non-paying tenants, all the troublemakers, all the criminals, and so on, and then fill it in with the right tenants once we've actually cleaned up the units and gotten them ready for the next folks. And we helped, we also hired security to help cut down on the violence, the theft, undesirable guests, prostitutes, drug dealers, things along those lines, and then renovate those units and increase the rents to be in line with what the market was already charging. And then we worked with tenants who maybe did have some trouble to actually collect the rent and find a way that's going to make sense for them and us to get everyone to a satisfactory outcome. And our collections rate, to show you just how different it was between having a professional management company and having the mom and pop previous owners, our collections on the property tripled in just 4 months, which is just, it's huge. So when we did ultimately sell the property, we actually sold it for a profit of $2 million. And that happened in a period of just 18 months. So we originally had planned to double the money in 5 years, right? 60 months. But in just a year and a half, we were able to get a total return of 80%. So we put it to vote with our investors, asked them, hey, we have this offer on the table. Do you guys want to take it and basically lock in the 80% return now in just a year and a half? Or do you want to wait the 5 years and hopefully hit 100%? Investors ultimately, they voted to go ahead and seal the deal and lock in the profits at that time, which obviously they're very happy and have since continued to invest in additional deals in the future. So that's just one example of deals that we've done. We've done, a handful of deals like this. We've never ever promised anything outrageous in returns, but thankfully we've been able to outperform every single time. And part of that is because we do put our own skin in the game on every single deal. We believe in these deals, and our goal is to build a company that we would invest in if it existed. But since it doesn't exist, we're trying to build it for ourselves and bringing on investors along for the ride as well. So our track record so far at our company, Disrupt Equity, is that we now own, really it's closer to $850 million of real estate. We actually just won another deal this morning, so that should be closer to 900 coming up soon. But we've basically bought about $800 million of asset under management. We've raised a total of about $350 or so million from investors, all retail individuals, no institutions or anything yet. Even though I have that background, we just haven't needed it, frankly. And the average net return that we produce to our investors annually is 50.6%. Okay, that's after all fees, after all splits, after everything. That's what goes to their pockets, which is great. And we've never ever promised something like that high ever, but thankfully we've been able to outperform and exceed our own expectations. And we hope to sustain that, or at least keep it relatively close in the future. We like to err on the side of caution, underwrite very conservatively, and assume the worst case scenario. And if we can fare well through the worst case scenario, when times are good in the market, we expect to outperform that expectation. And along the way, we've provided on average about 8% cash on cash. That's what most people want. And for a total equity multiple return on average of about 2.11x over the life of the deal. And just our company in general, part of how we would do that is the fact that we have taken an approach where we are vertically integrated. Okay. Obviously, we have the investment arm of the company where we invest on properties, but we also have decided to build our own in-house management company, property management company, that is. We've tried other management companies and some are fine, but the reality is that they kept dropping the ball and keep giving excuses and so on. So in order to ensure that our projections are hit on the investment side, we decided that really we need to build our own in-house property management company. And now our company, we have over, gosh, probably 250 people at this point. So we have a full-fledged operation that's humming along and doing really nicely. And on top of that, we also have in-house insurance and in-house debt brokerages. So quick note on the insurance side, because it is so key these days. In the past year and 2 years, really, you've seen insurance rates spike up, not just a slight increase, it's spiked up, and any operator will tell you, and anyone in the real estate world can tell you how bad it's gotten. But part of how we've been able to kind of insulate ourselves from these effects and mitigate the concerns that we'll have and keep our deals coming along pretty comfortably is the fact that we have our own in-house brokerage. We manage literally billions and billions. We underwrite billions of assets under that we insure. So that allows us to get preferential pricing and ensure that we have the best rates and know what's coming down the road so we can prepare accordingly today. And a lot of the big guys out there that you'll know of, they actually run through our company for insurance. So we see a lot of data out there, which is important because part of why we decided to build this company in the first place is the fact that we have a very strong background in the technology world. So one of our partners, actually my brother Ferris, he actually used to work in Silicon Valley, in Microsoft and other places, and he's got patents in his name and so on. So between his experience there and my experience at BlackRock, which is really a technology company that happens to be focusing on the finance world and obviously doing an incredible job, we decided to really take what used to be a pretty antiquated and archaic industry of real estate, really done the same way for centuries, frankly, and try to inject our own technology to optimize the entire process and approach and systematize it in a way that's predictable, consistent, reliable, and optimized. And obviously, Real Estate IQ is trying to do something similar. They're focusing on more single family, other parts of the asset, but we are specialized into the multifamily space. So it's a very powerful proposition. And by bringing it all vertically integrated in-house, we're able to really kind of cut out a lot of the middleman, optimize the process, and keep a lot of the control and data in-house. So we know really a year or two before our competitors what is going on in the marketplace, and we can start making steps today to account for that and plan accordingly. So with that, our current, if you want to hear about our investment opportunities as they come along, or if you ever have any questions or whatnot, we definitely welcome you to reach out to us. You can shoot us an email at invest@disruptequity.com, and that'll come right to me and my team. And we want to make sure that we get you answers and happy to jump on a call and chat and whatnot. But if you're interested, if you like what you hear and you're interested in kind of looking more, you have some cash that you want to deploy now. Our current opportunity, the one I just mentioned this morning, is a 405-unit property in the central epicenter of Houston, which is actually where we're headquartered. So we are in Houston. We have assets here. We literally have an asset 5 minutes away from this current property, the one that we won. So the economies of scale that come with that are awesome. And candidly speaking, this is probably the best deal we've found in the past 3 years. The returns like this are very atypical. And to give a quick story about why it's so attractive is the fact that there was another operator who had bought the deal previously, who's selling it now. They grew too fast and uncontrolled and did not do a good job. There was a hedge fund that was basically providing the capital for them, and they saw that the operator was tanking, and the hedge fund took over the deal. The hedge fund is not in the U.S., and they don't even do much in real estate. So they decided that they just want to exit real estate completely. So they are doing a fire sale across their portfolio. And that is exactly what we've been expecting to happen for the past year or two, that we know there's going to be a lot of distress in the market. And this is the perfect situation where the property itself is not distressed, but the seller is. So we're getting a really high quality asset, a high quality property that doesn't have much issues or at all. And our goal is basically to come in here and just improve the operations, the management side, even without having to do all the heavy lifting of rehabbing units, renovating them, all that sort of stuff. And we're exceeding targets basically in the above 20%, like closer to 25% deal level annual returns, which are much higher than we've seen for a long, long time. And it's the risk on this one is pretty awesome just because it's so minimal. But anyways, if that sounds appealing and you're interested, reach out, happy to talk, happy to show you more details and tell you all about it. But with that, unless there's anything else we'll have, would love to open the floor up to Q&A, and I welcome you to either I'll pass with Valentina a bit, but if you want to jump on the call or just type your questions in the chat, happy to get those addressed. So start off, I'm looking at the chat window and I see Ramses Ortiz asked, are these opportunities for accredited investors only? Great question. It depends on the deal. There is no one size fits all in how we do things. Some of our deals are accredited only, but I would say we also have a pretty good handful of deals that are open to non-accredited investors as well. This one in particular, we're working through the legal documents right now, trying to figure out what is going to be appropriate. I think there's going to be an opportunity for non-accredited investors to actually participate in this one. Don't quote me on that just yet, but we should know probably in the next 24 hours officially what the legal team has finalized and decided upon. But if not this one, then definitely we'll have more in the future that do come along. Okay. Next question from Jay. How much investment do you require? Any minimum? There's some flexibility here. I would say on average, our typical deal minimum is going to be $75,000 to $100,000, but there is some flexibility depending on your situation. I would just encourage you, if you're interested, reach out, shoot us an email, give us a call, and we can kind of see what might make sense for you and see what may or may not be possible. It's hard to say just because every deal does change. We've had deals where we raise as little as, I don't know, $3 or $4 million. Then we have deals where we've raised closer to $100 million. Every deal will have their own unique requirements. So it's hard to give a one size fits all answer, but I would say typically it does fall in that $75,000 to $100,000 range. Maybe we can drop it as low as 50,000, but let's have that conversation and let's see what might be appropriate for your situation and based on the relative deal that we may have available at that time. Any other questions? Please feel free to type them in the chat. Going once. Going twice. Gone. All right. Well, I'm sorry, we got a new one just come in. So what's the hold time on the new deal? That's a good question. This one really is not going to be a longer term hold. We're trying to figure out and see. This one, I would say it's going to be, I would expect it to be 5 years or less, but in the next 24 hours, we should know more officially. I say we're not certain because we've actually structured some deals in the past where the goal is to hold it forever, but that's been such a unique situation where for that kind of a deal, we actually gave 100% return to investors. So the idea being that they invest money and they get all of the money back before we take even a penny. And then once they get all the money back, then we split the profits thereafter. Something like that, that's something that you hold for life and really pass it on to your kids because you're playing with house money at that time, which is phenomenal. But those kind of deals are few and far between. They're pretty rare to find a deal that qualifies for that. We're trying to basically make the assessment. And again, we'll know probably by the next 24 hours, the final decision on whether or not this is going to qualify for that kind of a structure. If not, then it's probably going to be perhaps a 5-year play. My expectation is that it's probably going to be a little bit less, but we're probably going to state 5 years just to be safe. And I guess to give some historical context, our deals historically, we've typically projected about 5-year holds, but we've actually been able to exit every deal in 3 years or less. Again, just because we've been able to achieve our targets in a much shorter time frame with good offers to exit. So we've taken advantage of those. And part of that, of course, is the fact that we put it to vote with our investors and they make the decision to say, yes, we'd rather lock in the returns now versus wait a couple more years. And who knows what the future may hold at that point in time. So great question. But again, if you check up with me, if you want to shoot me an email, happy to reach out and follow up on this probably early next week with an answer. See a follow-up question on this too. What if interest rate is favorable in year 2 or 3? Would y'all be interested in that sort of capital event? Do you guys like refis? Great questions. Obviously, this is not your first rodeo, so you're asking all the right questions. So yes, we do like refis where it makes sense. We're not going to do a refi just to do a refi. Some people like to do that just to hold to, I don't know, let's say a previous projection. But as the market changes, you need to evolve your approach. And there are times where we would love to do a refi, but if the numbers don't make sense, then we're not going to. Right now, it's funny because you're seeing people who bought deals in the past year or two when interest rates were lower and they did not buy rate caps or anything, they protect them, and interest rates have gone up on them because it was floating rate debt. And they wanted to do a refi, and their investors are expecting a refi, but in order to do the refi, they actually have to call in additional capital from investors. So instead of doing a cash out refi, they're actually doing a cash in refi, which is just, frankly, it's pretty idiotic. It's foolish and not unnecessary, and it's not really benefiting investors in any real way. So answer to the question is, depends on the situation. We're always going to assess it based on the current market environment. We do like refis when the market and numbers make it make sense, right? Where it's applicable. But then if the interest rate is favorable in, say, 2 or 3 years into the project, yeah, we're happy to do a refi. Or if we get a good opportunity to exit the deal or a good offer to exit, we're more than happy to consider that. And again, it's not a dictatorship here, right? We definitely are the boots on the ground, kind of making this happen day to day. But our investors are our biggest partner. They are the owners of the deal at the end of the day. So we put it to vote with our investors and let them kind of decide, hey, what do you think? Here's the offer on the table. Do you want to take it now, or do you want to hold off and maybe see if things change in the future for a better opportunity? And ultimately, together, it's a collaboration. We decide all together what the approach is going to be. But great questions for sure. Any additional questions? All right. Will this be available to replay later? What do you think, Valentina? I know this is being recorded, so is this going to be available to share with the attendees and other folks? If you're speaking, Valentina, I think you're on mute, so we can't hear you. Okay, well, it doesn't seem like she's able to respond, or maybe not at the desk, but my understanding is that this is being recorded. I can see, actually, I can prove that it's recorded. So my understanding is that there will be a replay available that can go out to folks. So hopefully that will help you, and please watch the replay at your own leisure. And if you have any additional questions that come up after the call or after this presentation, please always feel free to reach out. We're happy to take care of you, and we try to provide a wet glove service. Ultimately, we understand the value of our investors and want to make sure that, again, that you're having an experience that you would expect if it was our own money, and what you would want for your own money. I'm kind of bundled that response, but appreciate everyone's time and attendance today, and I look forward to hopefully hearing from you guys in the near future. All right. Cheers.
Thank you very much. Have a wonderful day.
Likewise. Take care, guys. Bye-bye.
Bye. Thanks.